Welcome everyone to Finance with JCL. Thanks for joining me today. Very pleased to have you here. The topic for today is a stock review. Well, I'm going to be looking at Peloton. Thank you to one of my viewers for suggesting I look at this one. I'm going to have a review of them to see whether they are a suitable long-term investment for my portfolio. And I want to share my thoughts on the company based on the financial information in the main. Now, if you want to see more stock reviews like this, and it's one of the biggest parts of my channel, please subscribe. And we have stock reviews like this certainly at least every couple of weeks. And just as we get started, to confirm, I'm not a financial advisor, so do take your own advice, do your own research before you decide to buy or sell Peloton. Okay, let's get cracking. So the history of Peloton is that they were founded in 2012 and they provide what is termed interactive fitness products. Most famously, that is the exercise bike, but also a treadmill as well. They're probably the two most famous products. And they're kind of linked in, so it's not just a physical product, but you have interactive and online participative classes. So there is an element of competition between users and interaction as well. And as of the end of last year, for this information, they had 3.6 million members. So it's a reasonably significant number. And I think what we can say is they've had a bit of a stellar 2020, almost the perfect storm, because people have been forced to stay at home in many countries. Gyms have been forced to close for large periods of time. And therefore, this is exactly the sort of product where people get that sort of quasi gym experience, but in the comfort of their own home. So they had the perfect storms. I'm expecting their 2020 results to be rather promising. To start with Morningstar, and we can see the information here. 2017 revenue was about $200 million. It doubled it to 2018, doubled it again to 2019, doubled it again to 2020, and doubled it again for the trailing 12 months. They seem to be doubling every year. The gross margin looks about 40%, so it's fairly high, and they have finally made an operating profit for the trailing 12 months. They were very much in growth company mode before, and they're now up to 200 million. Now, we should caution that there have been recalls for, I think, hundreds of thousands of their treadmills recently, so their profits are going to take a hit in the next period. We should also have a look at the shares here, because the number of shares has increased by about 50%. What I want to have a do is a bit more of a dive into the P&L, because I want to see why they weren't making a profit before, and I suspect it's because of the perhaps advertising, but let's see what we've got here. We look at 2020, you can see here sales, general and administrative expenses growing rather rapidly, and that there was getting on for 50% of the revenue. And you can see actually for the last period, although the revenue went up by 50%, this SG&A didn't go up by 50%, it went up by a much lower proportion. And that's why they've been able to then generate an operating profit for the first time. Let's go back to the previous view. And that net margin was 5% for the last period, return on equity about 10%. And very importantly, because I want to understand whether the company's at risk of failure, they've got a very nice current ratio there of above 2. And debt to equity looks like it's low, 0.3. So at least for this high level view, it doesn't look like they are at risk of failure. So we'll just have a quick look at the balance sheet just to see anything that stands out. So first of all, there is a lot of cash here. That's $1 billion in cash equivalents, and also some short-term investments. So they've got a lot of cash sat there. I guess the thing for me here is that, are they growing too quickly? I think I'll refer back to sort of the Peter Lynch thing. He used to like companies that were growing around about that kind of 20-25% level. They're growing quickly, but not so quickly that it brings the other problems with it, or it brings hype and increased competition and therefore lowering of margins. I think the thing with Peloton is they're growing massively quickly, even before the virus situation. That's obviously give them a boost as well. And they've had the issues, as you've seen, with the recalls of the hundreds of thousands of products. So that is a symptom of growing too rapidly. So I guess from the Peter Lynch perspective, he's one of the the top investors of all time. I think it was 29% year return for 13 years. Memory serves. I don't think he would buy this. Now the company does have a moat, I think, and that moat, or perhaps we call competitive advantage. I think they've got a first mover advantage. First of all, they're probably the first name that's gone into this space and done it well. And they're certainly one of those kind of trendy products that has that kind of reputation. So I think immediately if you said to someone, exercise bike for home with interactive classes, the vast majority of people who know about that would probably say Peloton. It's an educated guess, but I think they'd say that. Now, there are lots of competitors that are coming on the scene. In fact, just when I watch YouTube videos, even in the last month or so, I've had several advertisements come up, not for Peloton, but competitors of them. So certainly other people are seeing this as a great opportunity and the competition's increasing. And Peloton, yes, they have the name recognition and cash for the balance sheet, but certainly their margins are very low at the moment. And the big question is, trading 12 months, you can see these doubles. What will happen as things open up again? Will the growth start slowing down? So they've been growing 100% a year, even if they slow down to, let's say, 30% a year, which is still fantastic growth. The market on growth companies generally doesn't reward the slowing down of growth. They're going to need to keep pushing through. But the question is, can they do that as people are allowed out and about again? Look at Yahoo. So this is a $30 billion market cap company. So you could be quite flippant and say 30 billion for some online gym classes and a very expensive exercise bike. That's one side of the story. The other side is they're innovative. They brought this to market first, and they're the leader in this space. You've got two kind of views, but 30 billion for a company that's only just made a 200 million operating profit, and is then having to do a lot of recalls. The profitability in comparison to the value of the company market, the PE ratio effectively, forward PE there's touching 200. So this isn't what you call a value investor play. If you're a value investor or you're a Peter Lynch investor, you probably don't buy this. And I like to consider myself more towards that space. So at the moment, I'm thinking, yeah, good company could well grow again, continues to grow. The price could go up, but from that value investor perspective, it's not quite right. Price to sales 8, that's not terrible. There's certainly growth companies with a lot higher price to sales, 20, 30, 40, you see. So it's not too bad on that front. Let's have a look at the analysts. There's a popular company. It's covered by plenty of analysts, around about 20. You can see here the history of March and April. Most of them are saying this is a buy or indeed a strong buy. And the growth estimates for the current year is almost 100%. Next year it's got 5,200%. The next 5 years it's got 59%. So the people that study the company in depth think it's going to grow 59% a year for the next 5 years. So this is considerable growth. And yeah, I think there's a chance of that, but I'd probably want the PE ratio to be around about 59 if it's going to grow, or even lower, going to grow at 59% a year. And 2022, the estimates here, 5 billion in revenue. So the analyst information Simply Wall Street is suggesting 54% a year. So there's a consensus among quite a large number of analysts of earnings growth of over 50% a year, which is incredible. You can see here they're suggesting for going 4 years ahead now, revenue 9 billion, earnings profit, if you will, 770 million. And we've got a 30 million market cap company. So if we compare those two, you're still looking at quite a high PE ratio. 30 billion divided by 0.77 billion. You're looking at maybe forward P of 39, perhaps. It's not what you call cheap at the moment, that's for sure. So a look at the latest view of the balance sheet. Debt's getting towards billion, but cash and short-term investments is 2.7. So that very much covers the debt quite easily. No dividend as you expect, it's a growing company as well. We have a look at the management, experience tenure, including the CEO, which is excellent news. And there's not really much to say, no significant activity in the insider trading. Then have a look at the ownership breakdown. The insiders own 7% or so. General public owns a very small amount, and then institutions own the vast majority of the shares. We'll finalise the view by looking at the price. Just before we go into detail there, I'd like to let you know that any shares that I'm now buying and selling, I'm posting on my Patreon site. If you'd like to have a look at that, get some more in-depth analysis on different factors, I can also hook you up my free household budget spreadsheet. I'll leave a link in the description below to my Patreon site. So the Peloton price history, and this is quite an interesting one because you can go back to 2019, and you can see here it's in the low 20s. Virus situation here, it went down to just about 19 there. Let's round that to 20. At the peak, 160. So if you knew about this company in March last year, and you foresaw that people are going to be forced to stay at home, gyms are going to close, and people still want to do exercise, you could have taken a bit of a gamble on this company and said, look, there's going to be a massive trend in this area. This company is perfectly poised to benefit from that. And you would have been handsomely rewarded with an 8x if you managed to sell, that is, at the peak. And perhaps if people got on the hype, you can see here, it went up very rapidly in December, 162. It pulled back all the way to 83 over the next kind of 5 months, 4 or 5 months. That's almost halving. So this is the danger of some of the growth stocks, is if you're trying to get on it during the hype phase, it could be a good investment, but you just timed it totally wrong, and you could then be 50% down. But someone who invested early would still be 5 times up. And even during the summer last year, after the first lockdowns have ended, you could still be about almost 100% up now. So yeah, do keep an eye on these growth stocks because they are much more volatile in the price sense. So for me, I can't see how this is better than many of the stocks in my portfolio. I think one could make money on it, but I'd much prefer to buy around about kind of the 50 to 60 mark. In my forward PE calculation, I think it was 39. And if you got that down to, let's say, 20, then this becomes a bit more interesting. And just for the comparative purposes, Simply Wall Street estimate is a fair value of 67. A little bit higher than mine, but not too far away. I think that it looks like it's an innovative company with a good quality product. However, I think they've been growing too quickly. Partly that's because of the virus situation. That's not necessarily their fault. But yeah, they're growing too quickly, and I just think at the price of 100, if the analyst estimates are correct, I think to make a good return, it's going to take. It might not happen, but it's going to take a long time. If it does, you're going to have to be waiting a long time. But for me, there's better stuff in my portfolio already, so it's not a buy for me. However, I'd be really interested to hear how many of you out there did buy Peloton during that growth phase last year and have made a handsome profit. If you have, very impressive that you've identified that trend and then profited from it. It's not an exact science. It is harder to value growth stocks sometimes via the traditional methods. I could be over or underestimating that fair value for sure. So thank you for joining me today. Appreciate your time, and I look forward to seeing you on the next one.